Well, good morning, Bob.
Good morning, Bill.
We're this morning in the middle of summer, and we're talking about bubbles. Not the kind you blow in the bathtub, but the kind that markets see. And if we go back years ago, many years ago, if we go back to Holland, we had the tulip mania, tulip bubbles, that sort of thing. Everybody had to have tulips, and all of a sudden, one day, the air was let out of the market, and down it went.
Yeah, there's, it's a common aspect of virtually every type of market that sometimes there are bubbles and then there are crashes. There is sort of a herd mentality that everybody sort of heads into one type of thing, and there's this buying frenzy, and then it collapses. And what we've gone through with real estate is a little bit unusual. At any given point in time, there are small bubbles in individual markets all around the country.
And of course there was a big national bubble.
That was what was different.
Well, so the perception is that bubbles, that basically that they inflate slowly and deflate quickly. And some people think they maybe deflate slowly. It's a lot like a flood. Everybody thinks a flood comes in slowly and goes out quickly, but a flood many times happens just reverse.
Exactly. So I was at a conference this past week up in DC, and much of the discussion was around what can we do to prevent those kinds of bubbles in real estate going forward. And I thought it was really interesting, the different approaches. There were a whole bunch of approaches, and many of them focused on saying, okay, what is the long-range sustainable price of a home? And lenders should really only lend to that sustainable price.
So basically, these were policy wonks and people, academics and that sort of thing, who had probably never made a loan.
Exactly.
Well, what did they think?
Well, it's funny because they had a lot of different mechanisms. First of all, what is the long-term sustainable price? That's a question.
Are we after that elusive equilibrium price?
Yes. We're trying to find out what that equilibrium price is. And truthfully, if you look at housing prices in the long run, there is a general trend that follows the consumer price index fairly closely for a long period of time. And then we have these bubbles and crashes from time to time, but there is a sustainable price. But as with an average, okay, an average is something that you can measure.
Higher and lower, right?
Right. But the problem is, with any given population, the average is wrong for virtually all of the properties.
So give us some solutions that were discussed, and we'll talk about each of those.
Okay. One that I really kind of liked was interesting. It was it was proposed by an unusual guy, Bill Foster, who's a congressman from Illinois, District 11. Really smart guy. Has a PhD in physics.
You just had to work that in, didn't you?
Well, and he's really smart, so therefore he's a Democrat.
Well, we don't make political comments on this program. That's an offhanded comment by Dr. Dorsey, but go ahead.
Anyway, he said, look.
I thought it was because he was a physics major, not his political affiliation.
Well, I don't know which it is. I mean, they sort of tied together.
Okay, well, anyway, go ahead.
The thing about it is that he said, look, there are all sorts of mechanisms that you can do, and I'm going from physics, and so I'm wanting a feedback mechanism to basically slow down a bubble and slow down a crash so that you're trying to stay toward the equilibrium all the time. So he built in a feedback loop, okay, and so he put a bunch of equations up there, and he said, now, this is all perfectly valid, but there's no way I could ever explain that to Congress. And so what I'm trying to do is I'm going to make a bunch of assumptions, and it really comes down to the following. You can only loan no more than what the price of the house was 4 years ago.
So basically, it does not matter appreciation or depreciation in the value of the house. It only matters what it was worth 4 years ago.
Right.
Okay.
And so basically, that's what that amounts to is that if you get a bubble, what that does is it says, okay, your loan to value, it gets lower.
Exactly.
And so that cuts off the source of funds and depresses the house.
Sounds like it denies people credit.
It does.
And so while we're trying to promote home ownership as a nation, it sounds like we're now, on the other hand, which is a good economic argument, denying credit.
Right. And, you know, I mean, that's essentially the argument that you hear in each of the studies is that, okay, we need, when the market gets hot, you turn back the dials on the credit.
You can't buy a house then.
No, you can't do it. But who does that impact?
That impacts the borrowers, the potential borrowers, the applicants.
Right, but who mostly? It impacts the lower wealth borrowers.
Well, sure, because they don't have the equity for the down payment.
Exactly.
And as the down payment gets higher and higher in hotter markets, it crowds them out of that market.
Right. And so, I mean, if you look at one of the other studies...
That's just discriminatory on its face, as we define discrimination in this country.
Well, it would seem to me to be that way, okay? And one of the things that they looked at, some other studies looked at, was where does the regional effect of bubbles and crashes within in various markets. And there was one study that looked at Montgomery County, which is just...
Montgomery County, Maryland?
Yeah, just north of D.C.
Right.
And so as you get closer to D.C., the bubble that occurred during the 2000 to 2006 period of time was significant,
right?
But there was no crash.
There was no deflation.
Right.
The air didn't come out of the balloon.
Right, and so it's sustained, you know, but as you move away from D.C. to the lower priced houses, to the more rural houses, then there was a huge bubble and crash. And the further you go away from D.C. or the metropolitan area, the more pronounced that was.
So there was no pain in D.C.
Very little. Very little.
That's been the argument for the heartland for a long time, right? There's
Right.
they don't suffer any pain. You get inside that beltway, you don't suffer any pain.
Well, it certainly wasn't in that county, I'll tell you. It was a very stable market as you got close to D.C. And, you know, that's one of the things. Anytime you have these types of mechanisms, it has all sorts of sort of perverse implications.
Yes, it does.
And you've got to be aware of those types of things. And besides, it's all well and good to think about this in the abstract, but think about in reality. You've got a hot market, people are wanting to buy houses, sellers are wanting to sell houses, you've got a lender that's got the money to finance that, and now you're being told, no, you can't do that.
Put the brakes on it. Well,
Right.
and the question is, does that really work?
Right.
Do those market brakes work? We've not had anyone try to put market brakes on
Not
real
like
property
that,
markets.
no, and
They try to put them on financial markets, and
they
they
put
do
more
put them on
money
financial-
supply, or at a global area,
Right.
they've done things like that, but not so much on those individual markets. And then the other thing that they're starting to come to grips with is that it's like the congressman's proposal. He was doing that on the basis of a state or a county in terms of measuring the price movement.
Right.
But what a lot of people pointed out correctly is that the county is quite different from the individual neighborhood markets within that county.
That's correct.
And the example in Montgomery County was where you saw the markets around D.C. quite different than the ones on the outside. So if you put a global rule for the whole county, then you're going to be wrong for most people.
Exactly.
Right? And so if you're going to do that kind of thing, you need to be very focused on a very small area within that county. And
Well,
that's a hard thing to do.
It is a hard thing to do. Let's step back and talk about basically bubbles and what creates them. We have lots of demand and not much supply, at least in a very short, finite period of time.
That will certainly create a bubble. There's no doubt about that. But you don't even need to have that. In economics, they've done experiments for many, many years where they've examined bubbles. And you can have equal amount of supply and demand, but if you start getting an expectation that prices are going up,
Right.
it doesn't really matter what the fundamentals are.
Do you have to have any friction in that market?
No, you don't. I mean, you can have that prices just zoom up in no time at all.
Because it's an expectation there's going to be a shortage?
Right, and the experiments that we ran, there are some people who consistently do very well in those markets, who are savvy enough to know when to get in and when to get out. and they make a lot of money.
Well, as long as you get out before the music stops, everything's good.
That's right, and it's,
Assuming you're on the right side of the tree.
yeah, and it seems to be some sort of intuitive thing with some people who are just very good at that. Because every rule that we used to try and come up with to say, okay, here's when you should get out, if you implement that rule exactly, you're too late.
Exactly. So you have to be ahead of that to
Right,
take
you
the
have to
trade.
anticipate when that's going to happen somehow.
Well, speaking of ending the trade, we're out of time today.
All right.
We need to end this trade. This is F&C's Morning View. I'm Bill Rayburn, Bob Dorsey. You all have a fantastic week.